Good evening, everyone, and welcome to Admiral Markets webinar. Today, Chris is with me, and we will talk about entering breakouts and fake out trading setups with high probability. As you remember, yesterday we had a similar webinar about breakouts and fake outs. I will show one setup today that was executed with our London version 2 breakout trading. But we also have some price action formulas and strategies to show you how to actually spot a false breakout and how to actually enter a breakout with higher probability. So before we begin, as always, our standard risk disclaimer explaining that trading foreign exchange carries a high level of risk and may be not suitable for all investors. Online education materials are available by Admiral Markets as Estonia for a global audience. And if you want to get a corresponding information on charting conditions and any other detail, you should visit www.admiralmarketsglobal.com, select your country, and contact an appropriate entity. Admiral Markets UK Ltd will take no responsibility for the information accuracy. This is solely my opinion and Chris, and these are not ABK's opinions, so this webinar is for informational and educational purposes only. So today's agenda: what is a breakout, a fake out? We will talk about Frankfurt fake out. I will show you Frankfurt fake strategy, but I will focus also on consolidation reversal and consolidation trend. I know that some people probably may not watch this live, so this webinar is recorded. And for all people who missed yesterday's webinar or who actually saw the webinar, I have additional things to explain. The thing is that I have received some emails about yesterday's webinar, especially about London version 2 breakout. So I will use that opportunity to actually show you again in this webinar how we can trade the London Open, second hour of London Open. Okay, so I know that can be maybe different to you because that is something that you haven't traded before, but believe me, it works. And today again, it showed some good movement, at least for scalp breakout trading. And you know that actually breakout trading is is a form of scalp trading. So it's not a positional trading. Okay, all breakouts are actually a form of scalps, except if you do that with let's say when you combine it with a positional trade. So you already know that we talked about head and shoulders, inverted head and shoulders, triangles, flags, pennants, wedge, dailies, highs and lows. So all of those were standard breakouts, and we already covered how to trade it. So there are actually a couple of ways to trade it, and you know that if you still don't know how we trade breakouts, for a price action, it's always trigger happy, a breakout retest, or breakout pullback retest, so-called breakout pullback retest continuation. So there is a fourth way. My favorite way is trigger happy, but only how I showed it on previous webinars, and I also like breakout retest continuation trades or breakout pullback continuation trades. So all of that information you can find on Admiral Markets YouTube. So don't hesitate to visit Google. Just type in YouTube Admiral Markets and you will see webinars on that subject. So, but we will not talk again about it because we already covered it. And we will talk about different things, especially consolidation trend breakouts, consolidation reversal breakouts, and false breakouts, how I do it. And you know that I'm a big fan of pin bars, and that is what we will also cover today. So this is, guys, this information about how to trade these standard chart patterns you can find on other webinars. Today we will speak about different things. So what is a breakout? A breakout is what occurs when prices exceed previously determined support or resistance levels. So usually breakouts are profitable, but in Forex trading, because there is no volume, you need to have momentum, guys. So that is the primary thing and the most important thing out of all advices that we will be giving to you today. So the most important thing is you need to have momentum, volatility. Without it, forget about momentum breakouts. Forget about breakouts. You will probably be caught in a series of losses if you try to trade the breakout without any momentum. The quick question at the beginning. Hello, Nana. I suppose this webinar is recorded. Yes, Ilya, this webinar is recorded, so we will definitely upload it. So the point is that long positions are triggered when price moves above resistance, while short positions are signaled when price drops below clearly defined levels of support and resistance. The problem can be if you see that price broke through resistance or support, but then it reversed. So then you are basically caught in a trade and you don't know what to do with trade. So that is when you're caught in a false breakout. There are a couple of ways to trade false breakouts. Again, guys, one of the ways we showed on previous webinars, you can use my system to trade false breakouts, fakeouts. You can also find it on Price Action Trading School. But also, I will show you another way how to actually use Bollinger Band confluence and pin bar today to trade false breakouts. And effectively, that is a counter trend trading. Okay. Now, breakouts on longer time frames create more significant changes, guys. Breakouts on shorter time frames have more impact on day trading. And breakouts do stop grabbing. That's the fact. And actually, if you are on the right side of the market, when breakout happens, you can actually make good profits for it. Stop grabbers are actually stop hunting patterns, where if you are in the move, if you are caught in the move that goes along with the breakout direction, you usually are able to make a good number of pips instantly. And I literally mean instantly. Sometimes even on Dragon Pound Yen, you can find 50, 60 pips on single minute or 2 minutes. So such is the strength of a stop grabber. Now, as we already explained, there are three, well, actually there are 4 ways, and the 4th way is actually a variation of breakout pullback continuation. So the first thing is how we trade it is trigger happy trade. The second way to trade it is a retest. And the third way is breakout pullback continuation. There is also the 4th way. It's called breakout pullback retest continuation. And again, you can find that information on our previous webinars. Consolidation trend breakouts, consolidation reversal breakouts is something maybe new to you, and breakouts is what we covered yesterday, but I will also cover it today. So but before I go deeper into it, I need to show a live chart, and then we will go step by step. There is a lot of theory crafting here, no slides. We will go to live charts directly, guys. So the first thing is this is actually our London version 2 breakout trading, and today well, you can see a lot of price movement, and well, on pound yen we had a nice breakout to the downside, and again MACD without histograms was lower. This was 10 a.m. London open time. Guys, I will not repeat the same thing I did yesterday. So for all of you who don't know what London version 2 open trading is, please refer to yesterday's webinar. You will see actually that how we determine a time zone, how we set up those indicators, and so on. But just for your reference, guys, here this was a breakout, 1 candle, second candle, the low of second candle, the high here, and what happened? Breakout to the downside, MACD was down, so we actually wanted to see a downward movement. And look at this, instant 20 pips. You see instant 20 pips before price pulled back and dropped again for a second time. So a pound yen, as I say, can give you nice pips during the morning, and this can be a one-day trade. We can use also the setup on GBP Swissy, guys, and well, now watch this, GBP Swissy. Again, 1-2, second candle low, second candle high, and here it is, breakout. Watch this, guys. Now watch pound Swissy movement. Potential 70 pips on a breakout. Okay, again, London open trading system version 2. I presented it yesterday, and I did pound yen on my live account today, but here I'm showing you how you could have traded it also. Let's check pound dollar. Pound dollar here. Pound dollar, well, again, let's count. First, second candle. Here's the low of the second candle, and here we are. The low has been broken. MACD is bearish, so we are only looking for short setups. Here we are, guys, in instant 21 pip. Okay. The question, Ilya, why you trade GBP Swissy when it's negatively correlated to Euro GBP? The simple answer, because GBP Swissy, GBP yen, GBP dollar, those are all those are all pound baskets. I don't trade Euro GBP with this system. So GBP Swissy, GBP yen, GBP Ori, you can trade it. Okay, I covered it yesterday. So yeah, you can actually search for setups. I'm mostly focused on pound dollar trading and pound yen, but here you can see what GBP Swissy did. So you cannot compare Euro GBP to GBP Swissy in this system, because this system is specifically designed to trade. Yes, it depends on a system, definitely. And this system is specifically designed to trade GBP crosses. And I'm looking at it to actually apply more of these. I'm looking now at GBP CAD, GBP ORI, and maybe in the future I will apply the rule that even these methods can be applied. But you look at this. GBP ORI, see second candle here, well, this was obviously a fake out. So at this point, I'm staying faithful to GBP or the GBPN, and you can see also GBP Swissy. So this is how you can actually trade these breakouts, and those are very, very accurate. Now, the other thing is consolidation breakouts. Here, guys, we can easily spot a consolidation. Here, let me see if I have it somewhere else. No, yeah, yes, this is a consolidation, and I will use this example. So here, before actually consolidation happened, we didn't know if it was if it will be a false breakout or a true breakout. So this is a consolidation. To actually pinpoint a consolidation, you need to zoom in and zoom out of your charts. So if you're watching at this time frame, you can always drop this lower, and you can always zoom out to see how consolidation looks like. So assuming that you are trading from this part, okay, and you are now watching the price. So 15-minute time frame, I prefer 15-minute time frame because to watch a consolidation, because consolidation is best seen on lower time frames. If you see a consolidation on higher time frames, such as 1 hour and 4 hour, the chance is that well, you might be staring all day because you know, consolidation takes time, and it's much better to watch it on the lower time frames, because a lot of people just cannot pay attention to charts every moment to see if something happens. And 1 hour candle needs a full 1 hour of price action to ever break consolidation. That is not the case with 15 minutes, because if you want to trade out of consolidation, you should do it on a shorter time frame. So 15 minutes is the optimal time frame between scalps and intraday frames. And 15-minute time frame I call a scalp swing time frame, because it usually gives you scalp swing positions. Here it is, guys. This is consolidation. You see, now you don't know where the price will break out. Again, going. But you see how now you can determine whether you will like the price to go either upside or down. What would you like? You place a trend line. So if you see an upward trend line, it means that the trend is to the upside. Now, if trend is to the upside and we see a consolidation rectangle, what is more probable, to see a counter trend move or to see a potential trend move? So if you apply the rule that you want to see a potential trend move, then you need to watch only for breakouts out of consolidation in the trend direction. So a trend line, a rectangle, well, you need to know how to draw rectangles. As I said, zoom in, zoom out of 15-minute time frame and just place two vertical lines. And here you see this is a clear consolidation. And now we are watching the price. You see, this could be a false breakout. We don't know if it's a false, but this could be a false breakout. Let's see. Okay, watch this now, guys. Well, if you traded this and you didn't close this here, well, you could have probably been caught in a false breakout. Well, that's a problem with consolidation breakouts. That is why I don't trade it. So the simplest and the safest way to stay out of bad positions is wait until trend develops and then go with our rules how to trade breakout. Trigger happy, breakout, pullback, continuation, breakout, pullback, retest, continuation. Use one of four methods. Because now, if you watch the price, here, guys, you might assume that this is a true breakout. Here. See, there is a trend line here. Okay, so trend line here. And now we might say, okay, let's use one of our rules to trade breakouts. One of our methods. Here, again, guys, you see, false breakout. But what can happen now? It can happen that you were caught here. You were caught here. So we have a double loss. So this is what usually happens when there is consolidation. Now, this applies to breakouts out of consolidation, breakout reversals. So you're caught in both breakout and a fake out. So how can I determine whether we see a false breakout or a true breakout? I use two ways to determine it. The first way I use is always, and that is how I do it, pin bar, guys. I love those pin bars. And I was telling you about it, really. Pin bar is my very, very bread and butter of those reversal trades. And I really prefer to use a confluence of a pin bar and Bollinger Band. So here it is. This is how you can set up your chart. Before that, you can always watch Bollinger Bands. Let's remove this one now from the chart, and I will go later to that one. And moving average. Now pay attention to this. Okay, so watch this 1 hour time frame, guys. Watch 1 hour time frame. We have Bollinger Bands here. Okay, we have Bollinger Bands set on those are default on 20s, and this is my bands indicator that doesn't use a middle line. I don't particularly look at a middle line. So how it goes, guys? You need to watch for pin bar rejections. Pin bar rejection, but inside, outside. That is how you can spot a false break. So guys, pretty straightforward. You can watch a trend. Now, this is how I I do it, you can apply this to your own method. Let's say you can use MACD, you can use Awesome, you can use whatever indicator you need to spot the trend. I personally, well, I don't need any indicator to spot a trend, because if I see this, well, this was uptrend. From this point, guys, it started to be a downtrend because price made a lower high and a lower low, and then it continued with a series of lower highs and lower lows. Now, this is a false breakout. As you know, trend line needs 2 touches to actually be valid. So these are 2 touches. 1 touch, 2nd touch. Okay? So watch this. We don't know what the price will do. Okay? So we are watching it, let's say, real time. So 1 touch, 2 touch trend line. The price has been making a series of higher lows and lower highs. Sorry, lower highs and lower lows. So this is an uptrend, and this is the first change. So if this is the high, this is the low, this is the lower high, and now we are in zigzag. Lower high, okay, lower low, lower high, lower low, lower high, lower low. Now this is a bigger pullback, and this is the time when you place a trend line. Now watch this. Okay? We don't know where the price will go. It follows the trend. So we are waiting. Okay, guys, here. A lot of people, especially new traders, would go long here. Okay? But the problem is, how I taught you to trade breakouts, this follows my teaching. Go with a trend direction, guys. And if you want to take a fake out trade, do it either with the system that I presented how to trade fake outs, or do it this way. This is a fake out. So you simply want to see whether the price will continue above the trend line. I will refer to that also on the second example, or it will go back inside the Bollinger. If the price makes a pin bar outside, inside Bollinger Band, that means it's a fake out. Okay? It means that it's a fake out and that you should trade in the trend direction. So fake out, you just open your trade here, because you're actually trading this fake out. If you had entered here, you would have been caught in a false breakout, unless you have closed your trade, let's say for 20 pips. Then you would make profits, right? But if you had actually skipped this, waited for candle close, and color change, you know how we trade fake outs. Please, guys, if you're not sure, refer back to my system and price action trading school fake out trading. And here it goes. Okay, outside Bollinger, inside Bollinger, and watch this. You see? So just be patient. You cannot trade successfully if you're not patient enough. You will see a lot of those pin bars, insides, outsides, during the trend, and it's always best to follow the trend. This is when you need to skip this. When you see this, even though this was successful here, when you see this, guys, skip it. This is not good price action. But here it was a good price action. Watch here. Outside, inside close with a perfect pin bar. No, this Bollinger is actually at 20. We use Bollinger 10 for Frankie fake system, Derek. This is different. This is a wider explanation of fake out breakout trading. Bollinger is set at 20. So here it is. Pin bar outside, pin bar inside. Watch this. It went down. Don't forget, guys, the price made a downtrend move, because here it was uptrend. For all people who cannot distinguish whether it's uptrend or downtrend, I explained it 1,000 times, and I will do this again. Simply draw a trend line and observe. This was a clear breakout, retest, continuation, and this signifies that the price is actually in downtrend now. Okay, and here it is. This is retracement in downtrend, and this is it. Here, another one. Watch this. Pin bar outside, inside, and drop. Pin bar outside, inside, and drop. Well, this is how I do it, and I don't need fancy indicators for this. This is more than enough. I apply it on my Camarillas. I also apply it to my EQ, and it's very simple. It's good, and a lot of trading opportunities can be found with following this. Bands are set on 20, and deviation is 2. Now another thing, I also wanted to show you this. If you put a moving average on, let's say on 200, and second Bollinger Band on the 100, see here, 100 to Bollinger Ilya, pay attention to 22, okay? So this is it, and moving average is actually here, 200 exponential. Now, if you see this, guys, you need to see a confluence of Bollinger Bands. Let's see, it doesn't show up. I need to visualize on all time frames. Here it is. So you need to find a confluence of 2 Bollinger Bands. When you see a confluence of 2 Bollinger Bands, you will have also a good chance to actually short this within the confluence. So as long as the price is below 200 EMA, we have a downtrend. Above 200 EMA, we have uptrend. Now, good thing is to actually zoom on lower time frames. Zoom on lower time frames to see the better price action. Let's say we will use, I don't know, Orient example. Okay, this is range. Let's find something better. Let's see, pound yen, for example. We need also to see, we don't want to be caught in breakouts, so we don't trade during these consolidation periods. I showed you why, guys, and I don't like it. But here, when you see a trend, this could be very interesting. So here it is, guys. If you see that the price is making a confluence with 2 Bollinger Bands, you can actually go with a trend. So this is when price is bearish. This is when price is bullish. So how you know that you can actually trade? Well, just follow. Screen is frozen. Sorry, guys. I don't know why. I probably. Well, yeah. I will release the screen now. So here you should be able to see it now. Yeah. So yeah, just follow upper Bollinger and lower Bollinger. When you see that the price is actually close to EMA and upper and the higher time frame Bollinger is pointing upwards, like here, you need just to see a confluence of other Bollinger. So here it is, and watch the pin bar. This is long trading opportunity. Okay, let's see. The price is short here. Watch this Bollinger. It's very, very short. So here, if this pin bar was just a little bit outside and inside, this could have been also a good entry here. You see, because higher Bollinger Band, it's set on 100 here, and it gives you the direction. You need to watch the angle of the Bollinger. Now, for this smaller Bollinger, you will see a retracement. And this is downtrend, so this is retracement. You see? Let's use other. You need a clear trend for this. You need a clear trend for this. Okay. Okay. The price is now going down here. You see the price is starting to go down, and here it is. Another example. So you will find a lot of these opportunities on lower time frames. But if you want to apply this to your own system or trade this, feel free. It should definitely help you make some good decisions. So here it is, guys, very simple. Follow upper Bollinger, follow lower Bollinger. Sometimes you will even see that 2 Bollinger crisscross and give you a pin bar. This is no-brainer trade. When you see this, this is a no-brainer trade. Watch this. 15-minute time frame, 215 pips. So crisscross of two Bollinger, pin bar outside and inside. Okay, and the last thing I wanted to actually show you guys is, I will do that now. This could be also interesting to how to distinguish from trend line false breakouts. Simple as this, guys. This is a trend line here. And you see there is two touch. So two touch trend line, you open a trend line, you draw actually a trend line and wait. Here we see a breakout to the downside. But you don't know if it's a false breakout or not. The best is to wait. And if the price pops back up the trend line with a bullish pattern, that indicates this was a false breakout and the price will continue. Watch this. You see, it went down, false breakout, it popped back up. Watch this. There is no popping back up because price continued. So this was a false breakout, no continuation. Place another trend line here. Okay, this was a breakout point. You know, breakout, pullback, continuation. This was breakout. Place a trend line, horizontal line, and watch this. It followed after the breakout, so it's a continuation. So you know that this was a true breakout, not a false breakout. Because if the price made the same movement as here, made a breakout, and then in one or two candles, again, it went to the upside without breaking this low here, that would have been qualified for a false breakout. So that was my part. I hope that you enjoyed. Apply this knowledge. It will help you guys. And until Friday, trade safe, stay safe, and watch for possible dollar-yen shorts. Cheers, everyone.
Thanks so much, Ned. Great stuff there with regard to breakout and fakeouts. And I want to ask you, first of all, how you're doing, how's your trading? And second of all, do you use breakouts yourself? So just curious what you think of that. If you can use a chat, you can write back. All right, breakouts basically occur all over the place. There are tons of ways of looking at breakouts, as Ned was showing a lot of them already. They're occurring on all time frames. The thing is that we have basically correction momentum taking place on every single chart at every single time frame. And basically price is going to break out of those corrections. And we'll get momentum when that happens. Like in this example on the left, you see that price is retracing upwards slightly. We have support trend lines, indicating those corrections. And then when price starts to break through those trend lines, we have a breakout and momentum starts. So the breakout is the moment where price is transitioning from a correction into an impulse, into momentum. So yeah, those are interesting. Those moments can be good, but sometimes they could be risky as well, as Natty pointed out. And obviously, trading momentum has its advantages. So, but they can be risky when they just start out and when you're just trying to catch maybe the start. So trend lines are just an example. There are a lot of ways of looking at breakouts. This is just to illustrate how a breakout could look like. I myself do like to use trend lines. I like moving averages as well. So how do I measure when I think a breakout, when I think that the price is actually finishing a correction and starting or continuing with that momentum? One of my best methods is looking at the breakout candle. Nana talked already about the pin bar being a great signal that price is failing to break out. And I totally agree. I use the same. In fact, I use the breakout candle in various ways. So what I'm looking for for a good breakout candle are four things that you see on the right. First of all, a candle close must be near the low for a bearish breakout and near the high for a bullish breakout. There's no other way around it. It has to have A strong close, that means that the bears and bulls are in control of that particular candle. So if you're trading the hourly chart and that's where you enter the charts, you want to see an hourly candle that has a good close near a high or low. If you're trading the daily chart, then you want a good daily candle. If you're trading the 4-hour chart, you do not want, a 5-minute chart is not relevant, obviously. Okay. Second thing, you want to have a good size candle relatively to your time frame. So and pair, by the way. So for the pound yen, a 5 pip, or it doesn't happen maybe, but let's say 20 pip 4-hour candle is not a good size candle. That's a small candle. But 30 pips, for your dollar hourly chart could be very, very fine for a breakout. So it's all relative. But we want a decent sized candle relative and compared to the candles that we see around the breakout candle. We don't want it to be a tiny breakout candle. We want to have it, show that there's been a decent amount of participation, a decent amount of movement within that candle, so that there's more information, is more valuable. That breakout candle has more value, basically. Thirdly, we want a close of the breakout candle that is, in a bearish breakout, lower than the previous candle. So let's take a look at an example here. You can see, for instance, this candle right here. That candle, we have the red arrow, right, is lower. The candle low is lower than the previous candle. The candle close is also lower than the previous candle close. If we look at this breakout candle, you see the candle close lower than the previous candle, the candle low lower than the previous candle. And the opposite, of course, is true again for bullishness. Fourthly, I like to see at least half of the candle breaking through what I use for a breakout. If I'm using a trend line for a breakout, I want to see at least half of that candle push through the trend line. So when we look at this example right here, we have the arrow, at least half of that candle, a bit more actually, is breaking through that trend line. That's another reason why the breakout is good in that case. Why? Once again, candle, let's take a look at that example where I have the red arrow. Is the candle near the low? Yes, absolutely. Look at that. Just a tiny wick, nothing there. Is it a good size? Absolutely. How is the close compared to the previous candles? Strong. Is the majority of the candle beyond the support or resistance? In this case, beyond support? Yes. It's more than half the candle is below it. So this is a good breakout candle according to my books, according to my rules, and I would consider that a trade possible either right at the close, or sometimes I look for retracement halfway or to the 38.2 of the candle. I might fib the candle and look for a retracement to the 38.50 or maybe sometimes even deeper fibs for shorts to take it to the downside. How about the previous breakout candle? How about this one? Well, it's okay, but the size is smaller. The close is a bit further away from the low. So those are two kind of minus, slightly less, well points, although it still moves lower. The next breakout candle is a bit better, but we do see that it's running into another support level. So, a breakout could occur, but if it's bumping into a significant other level, you still want to be careful because it kind of reached the target already. When it breaks this trend line, the next target is this trend line. If it breaks that, it could be the next bottom, or it could be basically a target. That depends on other factors, what the target could be. But I like to basically use fibs and look at support or resistance. And if I'm intraday trading, I look at pivot points. All right, so here in this case, that bit of a bounce is not surprising because of the support trend line. So those are the things I'm looking at. This is why this is a great breakout. This is why it's an okay breakout. And I kind of rank it. I kind of say, like, there is sometimes very clear good, very clear bad. Sometimes it's iffy. Sometimes it's gray, and then it depends on other factors. If you're doubting, sometimes it's just best to stay on the sidelines, probably. But it's never wrong to consider other factors If the breakout candle is so-so, look at other things to make a judgment if it is worth it to trade it. You're looking only pin bars, even engulfing candle twins. For the moment, I'm only looking at one candle, which is the breakout candle, basically. And in this case, we're looking at this one and this one and 2. Only one candle. All right. Now, surely you can take a look at candlestick patterns. Here we see engulfing twins, for instance. You can obviously take that into consideration, definitely. All right. So, by the way, regarding my questions, I got 2 answers. Let's see. We got both trying to use it and learning different styles, and yeah, breakouts I think is a good mix. Is a good tool to have in your, let's say, arsenal or bag. But it is important to know when to use it and how to apply it, because you can use it in all kind of. There's so many situations you can use it. So you want to basically find the right spot to do it and find the right time frames. You want to make it a smart part of your plan. So fakeouts, I use the opposite basically. I look for weak breakout candles. Those would indicate these 3 things right here. On the right side, you see basically candle close. It's far away from the higher low. It's a small candle, and the candle close is not basically really doing too well compared to the other previous candle. So let's take a look at this example. You see a major wick here. That's a warning sign. Red lights should be flashing and warning you that this is not a good breakout. It is not a smaller candle. Okay, that's true. So this is fine, but this is definitely not fine, right? And the candle close previous to the candle close is okay. So in this case, it's primarily the wick actually that's warning us of an impending false breakout, which indeed happened, and the price not being able to keep the breakout alive. The bears were not in control. Now, would that be enough for an opposite trade? That really depends. I like to see stronger false candles. For me, just looking at this particular candle would not be enough to take a reversal trade, unless there are other factors that I consider. Perhaps there's a massive support level here. Let's just pretend that there was massive fibs. There was a lot of reasons to consider that prices are going to rebound stronger. Well, then that could be enough. If there's no confluence there, then it would definitely not be enough for me. I would look for a stronger signal. I would definitely look for at least the next candle, like a bullish candle like that. Strong candle close, look at that. Strong candle, candle close near the high, candle close above the previous candle high. That is a better signal. This signal on itself is not enough. I would need a candle that is at least a bullish pin bar like this before I would trade a false breakout. Sorry. All right, so next thing, follow through. So once you have a good breakout or a false breakout, either way, you want to monitor how things develop after that. Because a breakout that starts well might not have enough follow through, and a fake out that starts well might start to become a false fake out. All right. The first signal is not, the end of the story here. You got to keep an eye on it and see and be flexible. Basically, you want to measure how successful basically the breakout or fake out is. All right. So when we look at the previous example, all right, we see no, this is a new example, I think. But yeah, no, it's the same example but on different time frames. Okay, so basically we see a pretty good breakout candle here. So that would lead us to believe, because let's take a look at that. Why is it good? Remember, candle close near the low, majority of the candle below. Well, just barely, but okay, it's enough. And a pretty big candle. Those things are in check. Looks like a good breakout to me. I think that's fine. So how does that breakout continue? Well, we get a retest of the trend line. I wouldn't be too worried about that. We get a pin bar at the trend line. That looks fine. So all in all, I think the trade is looking good at this point, despite maybe the pin bar right there. I would look at the higher time frames though to keep an eye on that, and that's something we'll discuss in just a second. But with a pin bar like this right here, at that point, I would definitely want to see a follow through right there, right then. I wouldn't tolerate too much slack at all. I want to see that follow through, and I definitely don't want to see a push above the candle high. So if I'm in that trade, if I'm waiting for a pullback, for instance, halfway, and I took the trade on the 38 fib or the 50 fib, and I put the stop loss above this top, I wouldn't exit the trade because this is a pin bar. That looks fine. What I would do is use the high as a trail stop loss to reduce the risk. I would take a loss, but the loss would obviously be substantially smaller if I have a stop loss here and my entry is here, and I have basically a stop loss here. Well, you're looking at definitely about 60% less risk, probably 2/3 less risk, and I'm taking a third loss, not a full loss. That might not seem a lot, but if you do that regularly and you take 3 small losses, then you have 1 full loss. That means you only need 1 winning trade that goes more than 1-to-1 and you're in profits. That's a lot easier than catching 3 wins, right? Obviously. So that does a lot for the equity curve. So I would definitely consider that to be the best way to trade it, and that's what I would be looking for. All right. So how do you see continuation? How do you see if it's going well? There are a couple of things you can look at. Candlestick patterns. Are there any opposite, candlestick patterns that are going opposite against me? Time factor, that's a separate webinar, but I basically give 5 to 6 candles time for the breakout to continue. If the breakout does not make a lower low or higher high within those candles, as Nana was saying too, then we're getting a false breakout. Then we're not seeing a continuation. We want to see a rebreak. We got a break here, but we want to see a continuation. We want to see a continued push of that momentum, because that's what we're trying to trade. We're trying to trade the momentum to the downside or upside. And if we don't get that, we don't want to be in that trade, because we're going to, high chance that we're going to get a expanded correction. That's not why we're trading breakouts. We're not trading breakouts because we want to hang around in a cozy, tight, extended, long consolidation. No, we want to catch the fast, quick, one-directional momentum. That's what we're in for. We don't want to, stick around for sideways movements. So that's why 5 to 6 candles. That's the time I'm giving it. If it doesn't happen, I'm market exiting or trail stopping it and being very demanding and not giving it a lot of space anymore. Thirdly, is something you got to be very careful of, is chart patterns on lower time frames. I'm not a big fan of advocating to zoom in. Zooming out, it could be good. Zooming in, very risky if you don't know how to use it properly, because you could be psychologically, or from a trade psychological point of view, that could be tough. But yeah, zooming in, looking if there are any patterns. For instance, if there's a breakout, looking in lower time frames, if there's some mini bear flag, well, that their chances of continuation are looking better. All right, so time frames. Just a quick note on time frames. Breakouts can occur on all time frames. One thing I do want to note is that looking at higher time frames is good to see if there's a candlestick pattern going against us, or if there's a candlestick pattern going with the breakout. With the breakout is good for breakouts. Against us is good for fakeouts. So if I'm trading on the hourly chart, I'm keeping an eye on the 4-hour candle. All right, let's take a look. Or if I'm trading the 4-hour chart, I'm keeping an eye on the daily candle. Here in this case, you have a daily breakout. All right, so you want to keep an eye on the weekly candle. So that's the daily breakout. Once again, the left is the daily chart, and here's the weekly chart. And how does the weekly candle look like right there? Look at that red arrow there. That is A, a bullish candle, not a bearish candle. We got a bearish breakout. B, it's not a small candle, it's a medium-sized candle. It is candle close into the high. It's a candle close above the previous close. It has a substantial wick at the bottom. It is, what else? Candle close is above the previous close. I already said that. Well, now, you can clearly see that's not a bearish signal. right? So that that bearish breakout on the daily chart is over and out. It's not good. At the end of the week, forget it. That is end of history for that breakout trade. It's a false break, most likely. It's definitely not a good breakout to the downside. All right. Also, with breakouts, you gotta be aware that pullbacks will happen on all time frames. So don't panic because there's a pullback. Be realistic. Give it some time at the beginning. If it's taking too long, yes, then it looks bad. Do whatever you can to reduce the risk or get out for break even. But one pullback or even two, it's not uncommon. You're going to see you're going to see some retests sometimes before it continues. All right. So that basically leads to my advocation of having a flexible trade management. You don't want to stick to a trade too long forever, and after 20 candles and still not a lower low or a higher high, you'll still think, oh, this is going to work out. You want to have a clear, you want to have a realistic expectation. And sometimes, yes, it's you can still hang in there for that long. I'm not saying you have to exit necessarily, especially if you have a lot of good downtrend, uptrend, good reasons. If you do your analysis and you think, okay, let's take an example here. You take a trade in here, but you think that it's still worth hanging in with the stop loss here. There could be reasons to hang in a trade. I'm not saying, but you want to make sure that you're not overly stuck or committed to a trade for no reasons. All right, don't become biased with that. And a good rule of thumb is, would you advise your friend to stay in that trade? Because taking yourself out of the equation does a lot of good. If you're giving advice to yourself, you're going to have a bias. And the bias is going to be that you don't want to admit that the decision to enter was, I would not, the problem is that we tend to see ourselves as making a good or bad decision. And if we exit a trade, we think that we made a bad decision, which is not true really, but that's how we think. That's why we don't want to admit that the entry was for nothing. There are a lot of, we can talk about this for another hour. So there could be a lot of reasons why we don't want to accept that fact. When we have ourselves, when we give advice to ourselves, better is to think what a friend would tell us, or even ask what a trading friend would do in our role. But always try to take yourself out of that equation. You get a lot more honest answer than if our own ego is mixed into that equation. All right, so now you don't want to give up too quickly either on a trade, right? We don't want to be too nervous either. So that's kind of the ideal balance we want to strike. Don't get nervous from the very first minute. All right, give it some time. But then if you gave it some time, you want to be a bit more demanding and don't want to be overly patient. All right, so let's take a look at some live examples. Okay, I'll let you decide what to look at. What do we want to look at? You're in full control here. What time frame? What pair? How do we look at breakouts? How do we measure the breakout? And we'll take it from there. All right, Euro New Zealand 1 hour chart. Great. All right, let's see. How do you want to measure? What do you want to use? Do you have a favorite tool? I'll just scroll back. I don't know. I'll close my eyes and I say stop. I stop right here. All right. Oh, this week. Oh, okay. I'll go forward. All right. Well, no preferences, so let me add some moving averages and we'll use trend lines. All right. Let me get rid of this mini terminal. It's part of the MetaTrader 4 Supreme Edition. Very handy when trading, but I don't want to block your vision. So this week, let's see, started from July 20. Yeah, let's put a horizontal line there. I want to make it very clear when it started. All right. So we see strong momentum to the downside, or I would say even a trend to the downside. Prices below the short-term and long-term moving averages, and we see a pretty aggressive move up, a pretty aggressive impulse to the upside as counter trend. All right. So what we're looking for, it's hourly chart. Sorry, apologies. There we go. So on the hourly chart, it looks different. On the 4-hour chart, we already see that the trend is down, but on the hourly chart, in fact, when we look at the moving averages, price was in a very, very strong channel. That was already showing significant upside. If we're trading short time frames, we would already consider this an uptrend channel, right? Depending on how we look at the trend. But if we look at higher time frames, we know that this could be a serious correction within a bigger downside. So with that in mind, basically we could keep two things in mind. We can keep an eye on this trend line, for instance, because don't forget, if we break, these corrections can take and last long. We're in this upside, we're above the moving averages. So that's one thing we can definitely keep an eye on as well, is just a continuation against the trend, but with the momentum. So a trend line like that could have been an option we would use actually here. We would connect several tops. And if we were looking for a good breakout candle above that trend line. Now, the reason why I use trend lines and not only moving averages is because of the fact that the moving averages, sometimes the breaks above it are not enough. What I'm looking for basically here you can see is that just a small push above moving averages sometimes is not enough to really break away from those moving averages. It's like that the moving averages are pulling price back to it, pulling price back to the mean. So what I like to use is trend line, but not basically every single trend line. Trend lines that basically go into the moving averages like this, right, are riskier. All right, trend lines that are connecting tops that are outside of the trend lines are more stable, and if you get a breakout candle above it, those are signals that are often enough better. Now you still want to keep an eye on how as I said in the previous part of the webinar, you still want to keep an eye on how the breakout continues, and specifically zoom out to one time frame to see, in this case, if you get a good 1 hour candle, a good 1 hour breakout candle. You want to keep an eye on the 4 hour candle, because if the 4 hour candle breakout looks like this, right, that does not look good. Now, it could still work out. It's not a guarantee that the price will fail necessarily, but you want to take protective measures there. All right. So we didn't get that breakout, but we also know on the 4 hour chart that we were looking at a massive correction to the upside. So we could be looking for a counter trend break to the downside, right? Now, I don't think the hourly chart is the best for that. And I'll tell you why, because if I put a trend line that is connecting these bottoms, right, and these bottoms like this perhaps, all right, you can see that price is above the moving averages. So I like to trade with the moving averages. So this is definitely a counter trend break. And sometimes they work, but they're a bit riskier. So this is a decent sized candle. I would say it's a decent sized breakout candle. It is maybe the candle itself is a bit dubious, because not enough, in the sense that not enough of the candles below this trend line, the second trend line. So from that point of view, you can have doubts if that's a good breakout candle. To me, it looks pretty solid. I think it is. You could think about taking that trade to the downside, and you do get about 100 pips follow through. Of course, in retrospect, it's easy to say. At that moment, there are a lot of factors that play in. One is the candle close that is very near the low. I like that part. So this is one of those that, yes, no, they're close to each other, I would say. All right, trading is not. It's part science, part art. This is an example of that. So in any case, let's take a look at the breakdown of the 4 hour chart there. And I think that the 4 hour candle looks decent. All right, it looks decent. I think that is a good breakout candle. 4 hour chart, I think, has less reserves from that point of view. And, I think that was a good breakout candle. Now, the follow through is not that great. As you can see, we got a pin bar like that. And anyone who trade manages that and gets out of break even, I fully understand. and I think that was good decisions. If you didn't, and you hanged in there because you wanted to see 5 to 6 candles not break this bottom, 1, 2, 3, 4, 5, 6, then you had basically a good chance to get the next push through. All right, because this is candle number 6. If I would see a doji like that, I would probably just move the stop loss right above these highs like that. Limit the risk because originally the stop loss is probably up in here, and if my entry is at the candle close, then I'm reducing the risk to half, and I see then price making the lower low, and I managed to hang in there. Now, if the choice to hang in there or have a tighter trade management, am I going to be more passive or more aggressive, basically? Really depends on a lot of factors. I think that both are equally valid in this case. Whether I use the 5 to 6 candle rule or if I look at the candlesticks follow through, I think depends on factors like higher time frames, overall market structure. Considering the fact that this is a downtrend, there is something to say about staying in as well, just because of the trend point of view. Yeah, but you could also make an argument really about the moving averages being flat and therefore reducing the risk. So I think that here too, gray area, both are possible. All right. So that was a good breakout candle to the downside. Now, also consider the strong daily chart trend, downtrend. All right. So back to the hourly. Oh, all right. Where were we? All right. So we get basically another triangle. This is a steep trend line. Realize that because look, the trend line goes into the moving averages and the break is actually passive because price is going sideways. All right, so that trend line really didn't have much value. We don't get the upside break as yet. That could still have been a good breakout if it would have made the push. All right, and let's see if we can connect some more points. We could see perhaps here a good support trend line. Let me get rid of these in the meantime. All right. So here we got an hourly, and we got a full candle below it. It's a bit small, so that candle itself is maybe not a great breakout candle because of that. In that case, it could be good to either look to wait for the next candle or just break the low here, for instance. All right, but the breakouts occur on all time frames, and I'll show you right here. If we're looking and analyzing on the hourly chart, but we're looking for entries on the 50-minute chart, for instance. All right, look at that. You can see that this candle would have been the ideal breakout candle if you're using the hourly as an analysis and 15-minute for the entry, right? We got a breakout here, basically, break, pullback, continuation. Sorry, excuse me, here, break, pullback. So the next breakout candle would be the signal for the continuation. So there's innumerable ways of looking for breaks. This is the basically the heart, the rhythm of the market. Impulse correction, breaks and bounces. If you manage to read this as a language, you'll be so much wiser. You'll be so much more prepared for reading the market as that will give you a head or an advantage in the long run. So this was a great breakout candle. You got a good downside, plenty of pips to make profit, and that would have been a good basically breakout to the downside, opposite of the trend here on the hourly, but with the trend on the 4 hours, we know, and the daily. All right, so that was a breakout to the downside. I don't see any breakouts more to the downside because, here there were no trend lines. These are too steep. The next breakout could have been, again, this trend line, quite shallow trend line. Perhaps this one, I don't know. That would be maybe a good 4-hour breakout as well, to keep an eye on the 4-hour candle. In the meantime, though, there was a break to the upside. Now, in this case, I don't think it's a good 1-hour trend line. And why? Because the trend line has a lot of hits, first of all. The moving out, oh no, I just deleted it. 1 second. Or I don't know where it went, but Let me open it. I don't want to open a new one. I would like to continue with that one quickly. All right, I don't know where it went, so let me then quickly open a new one. Sorry for this delay. All right, now on top of it, I cannot find it. And it's Murphy's Law, I guess. Charts maybe here. No. Ah, just my luck. All right, let me, here it is. Okay. All right, unfortunately we lost our lines, but basically we're looking at the last breakout right here, and the moving averages are bearish. It's a huge trend line, so I think the 4-hour chart is in fact better than the hourly. Moving averages are, sideways here, so the trend line is not connecting highs that are above the moving averages. This is a risky breakout on both time frames. All right, because it's a trend line that is basically, it's a decent breakout candle, but it's small. It got some continuation after that. If traded, it will probably be good just to use the candle lows right here to reduce the risk to a bare minimum. It's a small candle, so that's always risky. We have a wick right here, so anyone who took that breakout candle, I think it's best to reduce the risk as much as you can. And I think that if you just take a very, very small loss, that's fine. That's fine. Now, if you're looking for the opposite, if you're looking for a fake out, I personally don't think that this candle signals enough false breakoutness. I don't think it's strong enough for me to look for a downside. Also considering the fact that the moving averages are flat on these time frames. Yes, the daily is down. All right, but yesterday was a bullish candle and flat moving averages too, and we're not below the moving averages here on the daily. So for me, it would be a bit too little evidence for short. If you're trying that, then here too, keep an eye on the follow through. What you would like to see is a break below that, but I'm not sure we have the stop loss exactly, but keep an eye on the follow through, as I already was trying to warn you for. In general, that's always a good tip. I think it's not a great situation either way. If you're in that trade to the upside, reduce risk. If you're in a trade to the downside, then keep an eye to follow through, I would say. All right. But this seems like pretty stuck in quicksand to me. So I like the downside trades here. Two decent breakout trades to the downside when looking at trend lines and moving averages and analyzing the candles and how they break. One more quick example on the dollar yen here, for instance. All right, here you can see trend line like that. Now this trend line is better because don't look at the long-term moving averages. Let me take those away so you don't get confused. But you see the trend line here is basically above those moving averages. So if you get this candle right there, that's a good breakout. It's below the trend line and it's below the moving averages. And you also see that the close, for instance, is right near the low. It's an okay size. It's not the best, but it's okay. And you get a good follow through. All right, so that's great. 5 to 6 candles continuation. And Caesar's asking actually about the fact that he's interested in my time factor theory. And we do have a webinar on YouTube. Caesar, if you could write me an email, and I will find that for you and I'll send it to you. And there's my email right there. So keeping an eye on these candles, on all time frames, really very big help. Just always take a look, identify what you're looking for, identify what needs to be seen, and then follow through on that. So, what I mean with that is, let me take a look at X. There we go. All right. What I mean with that is, for instance, here you can see a trend line break like this. All right, and you see the trend line is above the fractals, or we can even draw it like that, something like that. You can see it's above it. So the breakout to the upside could certainly be something that is maybe worth thinking about. And you want to be careful, not to trade necessarily too much in a correction, of course. But if you trade on a lower time frame, you see a good, basically, consolidation here, a triangle. So you can look for the breakout to both sides. Keep an eye on the 50-minute chart to look for a good breakout candle. This doji certainly wasn't that. This candle, so-so. There was really not a great breakout candle in this case. But maybe this one, or otherwise the two after that, could have been okay for a small push up here, as you can see on a 50-minute chart, still giving roughly 50, 60 pips to the upside. So this is how you can play around, basically, is what I'm trying to say, with different time frames, keeping an eye on decision zones on one time frame, but looking for the breakouts on a lower time frame. For instance, keeping an eye on trend lines on an hourly and 4-hour chart, keeping an eye on the breakouts on 15 and 1-hour chart. But once the breakouts happens, keeping an eye on the follow through, basically on 15, hourly, and 4-hour. You can keep an eye on all three of them, in fact, to see if the breakout is false or good. All right. So there's a lot of potential here. There's a lot of ways you can trade. So it's quite fascinating to view it in this manner. All right, folks. We're way over time here, so thanks so much. I don't want to hold you up anymore. Thanks for joining. Wish you all great trading. Take a look at our webinars next week. Hopefully, I'll see you then. And above all, wish you great trading. Cheers.